Good morning. This is Horizon's Middle East and Africa. Our top stories this morning. Volatility in Asian markets after China's weekend finance ministry briefing underwhelms investors with a drop in factory prices, reinforcing concerns about the economy. The U.S. sending an advanced missile defense system and associated troops to Israel to deter Iran. Meanwhile, the humanitarian toll deepens as fighting continues in Israel, Lebanon, and Gaza. Worries over China seeping into the commodities markets, with oil prices slipping. Traders also keeping an eye on the tensions here in the Middle East. It has just gone 8 a.m. across the Emirates. I'm Johanna Versace in Dubai. A pickup of where markets left us on Friday because the S&P once more eked out another record high for the year. We also saw some moderate positive gains for NASDAQ. The big catalyst on Friday was actually stronger than expected bank earnings coming through. JP Morgan blowing through expectations, net interest income coming in higher than what the market had penciled in. Wells Fargo also coming on the higher end as well of what analysts had estimated. And so on the back of that, we saw a bit of a push for financials propelling the S&P higher. But of course, the main theme of the week was some of the data that has come through. Inflation proving to be a little bit stickier than people had forecast. The prior week, we were speaking about the stronger labor market data. So all that has meant that the USD has been rallying quite a lot in the past month, or about 2% higher over the course of the last 4 weeks. This morning, also keeping a close eye on Brent. We are slipping. We're down about 1.1%. And again, here, as we've been talking about, it's been a pull and push between some of the geopolitical factors that are keeping oil underpinned versus some of these signals that are coming through from China, and the fact that most recent stimulus measures, while initially were met with a very positive reaction, there are some questions now being raised about the sustainability of the demand signals coming through from China, especially with those deflation numbers over the weekend. So that's pulling oil lower this morning. Asia Pacific, as you can see, the handover today, somewhat positive, though we're going to get into that in more details. But essentially what we're seeing is some green in China stocks, but the Hang Seng is actually trading in negative territory. So why? We'll get to that in a moment. And then just finally, just a quick recap. I did start off talking about some of the positive price action we've had in U.S. banks. But this is, if you take a look back over the year, Goldman Sachs has been the outperformer for 2024. So far, up 34%, almost. JP Morgan up 30%, even accounting for Friday's move, other banks as well. So it's been a very solid year for U.S. banks as we continue with earnings season. But let's talk more about the stimulus measures that came through from China over the weekend. China's highly anticipated finance ministry briefing on the weekend lacked the firepower that equity investors had hoped for. Beijing's promising more aid for the slumping property sector and indebted local governments, but economists aren't convinced it's enough to defeat deflation. For more, let's bring in our China correspondent Minmin Lo in Hong Kong. First of all, just give us the highlights of what we got from this Ministry of Finance briefing and why the market was a bit underwhelmed.
Yeah, I think investors were hoping to hear that 2 trillion yuan in additional stimulus, but we didn't get any magic number. But I would say that that is still possibly on the table because any budget revision, remember, still needs to be approved by the legislature. So when the NPC Standing Committee meets later in October, that might be a more appropriate time for us to hear about the size of this additional fiscal stimulus. But we did hear a number of other measures that the Ministry of Finance is prepared to take, and that includes a one-off debt swap for local government. And this is key because we know local government spending has been lagging behind, and this would alleviate some of the pressure that local governments face in repaying their debt and instead focus more on expanding spending for the economy. The other key thing is the issuance of special sovereign bonds to recapitalize the big banks. The banks already have sufficient capital, but it would help alleviate some of the profit margin pressure of these banks, especially after the PBOC had been calling for cuts to mortgage rates as well as slashing of the key policy rates. We're also seeing the widening of usage of local government bond funds to buy up unsold homes to convert into social housing and also to buy back idle land as well. So again, property measures that would help accelerate that home buyback program that the PBOC has introduced. But I think what markets are particularly disappointed by is the lack of demand side stimulus to target the boosting of consumption. There was cash handout in the form of doubling the number of scholarship quotas for college graduates, but nothing to the scale that investors were hoping for when it comes to cash handouts for consumers.
Yeah, and to that point, Min, keeping a close eye on some of the inflation data that's come through this weekend. The PPI figure coming in at minus 2.8% year-on-year, consumer goods down 1.3%, so still very much in deflationary territory. Even the CPI figure, core CPI, is still sitting at 0.1%. Does that not tell you that whatever they have done so far has not been enough to counter these deflationary forces?
Yeah, certainly. I mean, both CPI and PPI had missed expectations. And as you said, if you strip away the more volatile food and energy prices, core inflation is just hovering above zero now. That's the weakest print that we have seen since February of 2021, which is basically more evidence for why the government really need to rebalance the economy to bring consumption back to the table and to shift away from this two-track recovery that we are seeing right now. And it's also this worsening of the deflationary spiral that we're seeing, because it's not just a weakness in these prices, it's also weakness in new higher wages. Wages for third quarter had declined by 0.6% according to an online recruitment platform. So that spiral that we're seeing here is what is really taking away confidence from the economy and from equity investors as well.
Yeah, very clear. Min, thank you so much for giving us the latest there. China correspondent Min Lo in Hong Kong. Let's continue the conversation now with Eric Robertsen, Global Head of Research and Chief Strategist at Standard Chartered. Good to have you with us, Eric.
Thanks for having me back.
I've noted that Goldman Sachs over the weekend actually upgraded their forecast for growth for the Chinese economy. They see 4.9%. This year was 4.7. They've upgraded next year to 4.7 from 4.3. Have you also raised or lifted your growth forecast based on the stimulus measures that have been revealed the last 2 weeks?
No, we haven't.
Okay.
We're still at 4.8% this year, 4.5% next year. We had serious concerns about downside risk to the economy up until about a month ago, and we think what the measures have done so far is truncate that downside risk, right? They've taken away, through their commitment, I think some of the downside concerns. We still have yet to see really tangible fiscal stimulus numbers. And so what I would argue is that we probably can expect to see fiscal spending shifting from a contraction in the first 8 months of the year to something more positive in the back end, but probably not enough to shift the annual number for the year.
Do you think there is a willingness to introduce fiscal measures that will support demand side growth, which is what Min was just talking about?
So this is the key piece of the puzzle for us. Most of the measures announced over the last 6 to 12 months have been supply-side measures. There is certainly an indication of commitment to do more fiscal. The concern that I have is that there is so much debt-financed spending. All of the talk is on increasing debt issuance, increasing debt financing to make funds more available. That doesn't change the demand side of the equation. And so I think what you're seeing is increased willingness from the government and the party to stimulate and to direct spending into the economy. The question is where. If it's more infrastructure spending, not sure that's going to drive things. On the consumer side, that's where the real demand deficiency is.
What do you make of the market reaction we've had? It's certainly been quite volatile the last week for Chinese equities, but overall there has been quite a stupendous rally over the course of the last 2 weeks, with many of these indices up more than 20%. Does that continue, or have we fully priced in the measures that were already unveiled?
I don't think we've fully priced in the future measures, which I think are likely to come. And what I think has happened with equities is you've taken away some of that downside unknown, which was becoming so overwhelming in the market mindset. For the future, they have made it very clear that if what they've announced so far is not enough, they will do more. But again, I think what equities are starting to get to grips with, and commodities as well, by the way, is that we haven't seen an upfront number from the fiscal stimulus that matched market expectations. There's a promise, there's a commitment. But at some point, they're going to have to deliver on that. And so I think in the short term, you probably see a little bit of cooling of expectations.
Do you think they will eventually succeed at breaking out of this deflationary cycle, though? I mean, that's the key question for global markets.
100%.
Yeah.
And for us, the key question on the deflation that we're seeing is, can you see a change in the demand for credit? We've seen cuts in interest rates. We've seen excess liquidity. But demand for credit keeps going down. And if people aren't willing to borrow to invest, prices are going to keep going down because they just create excess capacity. And I don't think they've changed that yet.
Yeah. So it's interesting. I was reading in actually one of your reports that 5-year break-evens in the U.S. have actually climbed about 40 basis points in the last couple of weeks. So that tells you that the market perception of inflation or inflation expectations has changed somewhat the last few weeks. People are expecting things to be sticky.
This is the really interesting narrative of the last 2 weeks, which I don't think is getting enough attention, which is that from some measures, and by the way, the same measures in Germany are also picking up, which is really surprising considering the weakness of the economy. But in developed economies, it looks like some of the downside that we saw in inflation measures and inflation expectations may have found a floor. And if we have found a floor at the current level, then we have to ask what happens next year.
So what do you think that means for the Fed and the expectations of this interest rate cycle? I think there are about 150 basis points of cuts priced in by mid-next year.
That's right. So we argued as recently as 2-3 weeks ago, before the labor report, that we thought that the market's expectation of the terminal Fed funds rate was too low. I mean, people were talking about a 2 handle.
Yeah.
And we said, look, the resilience of the U.S. economy is still in pretty good shape. Yes, it's slowing, but it's not a recession. It's not a hard landing. And so in that scenario, a terminal Fed funds rate with a mid-3 range looks a lot more reasonable to us. And 150 basis points by the middle of next year, I think, is now fair.
Does that have ramifications, though, on the broader economy, the real economy, the fact that this so-called neutral rate that the economy can sustain now is going to be in a 3% handle rather than a 2% handle?
I don't think so.
How should we think about a higher terminal rate, is my point.
Look, I think if this is happening in a world where the unemployment rate is still in the low 4s, you're still seeing monthly job creation of, let's say, 150 to 200,000, and even if the U.S. economy is only growing 1.5%, maybe 2%, that's probably okay. Financial conditions are very loose. Credit spreads are tight. Equity financing is low because the stock market's back near the highs.
Yeah.
So I think the Fed may have some wiggle room here.
Yeah. What do you make of the move in the USD the past couple of weeks? Again, it has been marching higher at 2%. And actually, if you look at the year-to-date performance, the dollar is actually up 2%, which means most of it happened in the last couple of weeks because we dipped in the summer.
I think it's almost exclusively down to the reduction of rate cut expectations. I know that's a mouthful, but you know, we've seen U.S. rates climb a bit higher since the labor report. People realize that the Fed is not cutting to 1% or 2%, and people say, okay, the dollar depreciation that we saw was all because of the collapse in U.S. rates. Now, there's some other factors, right? The U.S. election looks very close at the moment, too close to call. That's putting a bit of risk premium back in the dollar, and I think that makes some sense. Yeah, okay, makes sense. Eric, thank you so much for joining us this Monday morning. Eric Robertsen, Global Head of Research and Chief Strategist at Standard Chartered. Thank you. Well, coming up, the Israeli military says a Hezbollah attack south of Haifa killed 4 of its soldiers. The latest on the Middle East conflict next. This is Bloomberg. Welcome back to Horizons Middle East and Africa. I'm Jumana Bersechi in Dubai. The Israeli military says 4 of its soldiers were killed south of Haifa on Sunday in a drone attack launched by Hezbollah. This marks one of the deadliest strikes against Israeli forces since they launched ground incursions into Lebanon. Hezbollah says the attack comes as retaliation for Israeli strikes on Beirut on Thursday that killed 22 people. Meanwhile, the Associated Press says explosions hit early Monday outside Al-Aqsa Martyrs Hospital in Gaza's Deir al-Balah. The hospital says at least 3 people were killed and more than 50 injured. The Israeli army says it hit a Hamas command center located in central Gaza in a building that had previously served as a hospital. Local hospitals in Gaza also say an Israeli airstrike on Sunday killed at least 20 people at a school in Nusayrat camp. Our UAE Bureau Chief Dana Khesh joins us now, along with Bloomberg's Galit Alstein in Tel Aviv. Dana, maybe let me just start with you. And of course, for much of the last couple of days, the world has been awaiting for Israel's response to the Iran ballistic missile attack.
But in the interim, it really does feel as though the conflict on the ground has been expanding on several fronts. Just give us the latest.
Yes, good morning. We saw yesterday a Hezbollah drone attack on an army base in central Israel, killing 4 soldiers there and wounding dozens. That's the deadliest attack by Hezbollah since Israel started the ground operation in South Lebanon. So Hezbollah has been firing rockets and drones, ever since, of course, October 8 of last year, and they've upped their attack since Israel started the air campaign in Lebanon to target the group and dismantle it. But most of them have been intercepted. So Hezbollah in a statement said that they fired rockets at several towns in North Lebanon to, quote unquote, distract the defense system and at the same time launch this drone attack near Binyamin. They said they wanted to distract the defense system with the first one and warned that Haifa, which has been a target of heavy rocket attack from the group in recent weeks, and others would be, of course, a main target again and again if Israel continues its attacks. And that is, of course, we know Israel is not going to stop until the main goal is achieved, which is bringing back the thousands of people displaced from northern Israel. And now we see the ground invasion, of course, expanding. We saw a lot of footage yesterday. Hezbollah is saying they've been stopping Israeli soldiers from coming in, but we've seen a lot of breaches along that border, along that 120-kilometer border. And in Gaza, this is, of course, seeing Israel is fighting on 2 fronts in full, in Gaza and Lebanon. And as you mentioned before, an Israeli strike killed at least 20 people. That's according to the health authorities there. And these will continue as Israel continues with its other goal, which is now probably a secondary one, is to completely dismantle Hamas in Gaza.
Yeah, Galit, let me just turn to you because I guess the incident overnight and the fact that 4 of these soldiers are reportedly killed from the rockets fired from Hezbollah into central Israel also serves to underscore the importance of having an equipped air defense system. And to that point, we heard from the U.S. yesterday, the Pentagon are going to be supplying Israel with an advanced missile defense system called THAAD. What do we know about this system?
Yes, so as you say, good morning. The U.S. did confirm yesterday that it would be sending the THAAD, which is an advanced missile defense system. They would also be sending the troops associated with this system to help shield Israel from ballistic missile attacks by Iran. So this system, which is called in full the Terminal High Altitude Area Defense, these batteries will work as a counterpart to Israel's Arrow system, which is at the very top of a multi-layer missile shield. And the deployment of this THAAD system does come as Israeli Prime Minister Benjamin Netanyahu's government is planning retaliation for the October 1st ballistic missile attack that involved almost 200 launches from Iran toward Israel that were largely intercepted, and yet they did manage to hit 2 Air Force bases and caused a large extent of civilian damage to hundreds of homes in Israel, in central Israel, as data that we received yesterday revealed. This was rather by direct hits or by debris. So the deployment of this defense system by the U.S. does signal that there is more to come in the direct confrontation between Iran and Israel, and that there is preparation for an ongoing exchange. Unlike in April, when Iranian drone and missile attack was answered by just, a moderate warning strike from Israel. This time, we're anticipating an Israeli response, then an Iranian retaliation, and so forth.
Yeah, and indeed, this all goes towards that goal of deterring Iran from further strikes. Dana, I also just want to turn back to you and some remarks that the Israeli Prime Minister made over the weekend directed at UNIFIL, which is the UN peacekeeping operation in southern Lebanon, with Netanyahu saying that accusing them essentially of providing a human shield to Hezbollah in some circumstances. Just talk us through what's going on there and why this is also potentially becoming a diplomatic incident.
Right. So when Israel began the invasion, there were a lot of concerns and questions over the UNIFIL's, the peacekeeping forces, presence along that border. That's basically where Israel is mainly operating, right, along the de facto 120-kilometer almost border along Israel and Lebanon. We saw 4 peacekeepers wounded from Israeli attacks, according to what UNIFIL is saying. And yesterday there were more UNIFIL statements saying that Israel destroyed a main gate, and there were several peacekeepers who were wounded from, smokes or explosions. Now, this is kind of the sticky point. Netanyahu is demanding, and Israel has demanded before, that UNIFIL evacuate the positions along the border. And it seems the UN and countries which contribute the peacekeeping force, soldiers to the peacekeeping force, want to maintain the presence there. They say this is important for peacekeeping. Now, yes, there is no peace along this border. And these guys and these peacekeeping forces have been deployed in 2000, and that presence was expanded in 2006. And so the idea is we keep these along the border, maybe to limit all of the operations and limit the how this operation by Israel would be expanded, because for the peacekeeping force, of course, they're trying to prevent a prolonged operation or a prolonged invasion that could definitely exacerbate the situation along the border and really raise tensions and escalate them, not just in South Lebanon, but in the region as a whole.
Bloomberg's UAE Bureau Chief Dana Khrish and Bloomberg's Galit Alstein in Tel Aviv. Thank you so much for your reporting. Now, coming up, the UK Prime Minister Keir Starmer will speak exclusively to Bloomberg later at the UK International Investment Summit. That interview is coming up here on Bloomberg TV at 5:30 p.m. Dubai time. Welcome back to Horizons Middle East and Africa. I'm Johanna Bersace in Dubai. Let's take a look at how some of these equity futures are reacting. S&P once again making a record high on Friday as the market digests some of the better banks earnings that have come through. But over the weekend, we had sort of an underwhelming press conference given by the Chinese Finance Ministry. As you can see, it set the tone today. We are slipping into the red. When we come back, we're going to be talking about Dubai and the fact that it's becoming one of the world's top destinations for expats and tourists. We'll be back. Good morning. This is Horizons Middle East and Africa. Our top stories this morning. Volatility in Asian markets after China's weekend finance ministry briefing underwhelms investors with a drop in factory prices, reinforcing concerns about the economy. The U.S. sending an advanced missile defense system and associated troops to Israel to deter Iran. Meanwhile, the humanitarian toll deepens as fighting continues in Israel, Lebanon, and Gaza. Worries over China seeping into the commodities markets, with oil prices slipping. Traders also keeping an eye on the tensions here in the Middle East. It's just gone 8:30 a.m. across the Emirates. I'm Johanna Bersace in Dubai. But what we've got was a better end to the week with Wall Street. S&P eking out yet another record high, up 0.6% by the close on Friday, as the market pieced together the information coming through on the economy with the prior week's non-farm payroll print coming in better than expectations, slightly stickier inflation numbers coming throughout the course of last week, and then the beginning of the earnings season with very strong beats by both JP Morgan and Wells Fargo. So that sort of propelled the S&P higher. But over the course of the last month, we've also been keeping a close eye on the greenback, the USD, about 2% firmer over the course of the last 3 weeks. And in today's session, up about 0.1% as well. Bear in mind, by the way, today, US bonds are closed for trading. It is Columbus Day, so we're probably going to get slightly thinner liquidity than usual in the US session. Brent also in focus, back to $78 now. We got to about 80, 81 throughout the course of last week. Again, geopolitical developments. The world is waiting to see how Israel is going to respond to the Iran ballistic missile attack. But at the same time, some of those weaker signals coming through from China also weighing on the energy complex. And then Asia Pacific, they hand over today. Bit of a mixed bag. We have Hang Seng trading in the red, Chinese indices trading in the green. Ava will tell you more about that in the moment. But this is just to tell you that the handover from Asia today is somewhat somewhat mixed. As we look ahead to banks' earnings season, though, more banks are going to be reporting this week. A special eye is going to be on Goldman Sachs, and you can see it is the outperformer as far as U.S. banks are concerned year to date, up more than 34%, JP Morgan up 30%, Citi up 28% as well. So all pretty much outperforming the S&P for the most part of this year. But again, a lot of focus on those investment banking numbers. And you may recall that David Solomon, the Goldman Sachs CEO, just a month ago warned that investment banking trading activity might be lower as we head into the third quarter. So we'll keep an eye on that throughout the course of this week. But for now, let's also check in on how markets in Asia are faring. Avril is in our Singapore studio. Avril, just give us an overview of why these Asian markets are split on how to interpret the data we got through from the China Finance Ministry on Saturday.
Yeah, getting to terms with what we got from the Chinese Finance Ministry briefing. And though we didn't get a headline dollar number in terms of additional fiscal stimulus, there are some optimists out there who see, hey, at least there were some signals of support for the property sector as well as local governments. And as you know, Jumana, these are the pain points for the Chinese economy. So some are taking away the positives, including the likes of Goldman Sachs, right, who upgraded their forecast on GDP for China for this year and the next. They see this as a sort of turning point in terms of the cyclical policy management. Though there is a caveat here, if you're looking at these onshore stock gains in the morning session, we are also seeing those ETFs that the national team favors, seeing a fair bit of buying. The Hang Seng, it has to be said, has managed to pare some of the declines of about 2.6% from earlier on in the session. So again, a bit of a positive takeaway from events over the weekend. Flip the board, because it's not just the Chinese assets, the Chinese proxies are also in focus as we see the commodities have mostly slumped, but iron ore managing gains of 2+%. The currencies such as the Aussie dollar and Kiwi dollar managing to pare the declines from earlier in the session as well, Jumana.
Avril, thank you so much. That was Avril Hong in Singapore with the latest on Asian markets. Now, Dubai's post-pandemic rebound has lured expats and propelled its key stock index into the ranks of top performers, but it has come at a cost. The glut of lawyers and bankers willing to fork out premium prices is pushing up property values and rents while intensifying competition for school admissions. Let's bring in Bloomberg's Mideast economics reporter, Abir Abu Amar. Abir, I read your note, read your report over the weekend, and one of the statistics that stood out to me is right now, Dubai has a population of 3.8 million, but that number is expected to surge to 5.8 million by 2040. Really big numbers here. What is driving the boom? Why are so many people moving to Dubai?
Yeah, Jumana. So look, I mean, last year, Zainab and I wrote this report about Dubai pricing out expats because it's become too expensive, and we decided to take another look at how the situation was now, 1 year down the line. People are still coming in. You see the traffic. I came in early this morning, so I skipped the traffic. But, you could tell that the financial district primarily has been affected by this boom of hedge fund managers, asset managers, bankers, financiers. We know that the number over the past 5 years has accelerated by 70% in terms of DIFC employment. And this year, DIFC is expected to employ even more people. So we know that there are two parts of this, right? One part is everyone from the likes of London, Hong Kong, and even the US in some instances is looking at the region and thinking, this is where I need to be. And Dubai stands out as the financial hub in the region. And then there's the fact that, Dubai or the region, in a bigger picture, low taxes, environment, the weather is pretty nice, ease of doing business. So those are all reasons that are contributing to this.
The thing is, that's all very great, but at the same time, you've got to wonder whether the infrastructure is actually there. We talk about property prices, everyone's favorite topic to talk about over here in Dubai, but they keep moving higher. Traffic is getting worse. It is becoming increasingly difficult to move around. And then also, you don't have to go that far. I remember my very first week here at Bloomberg was the week of the Dubai flooding, and there were lots of questions then about the drainage system. So does Dubai actually have the infrastructure to support all these people who are moving here?
Yeah, no, it's funny that you mentioned that, because I was just going to mention your first week being possibly the worst week to start in Dubai. But look, I mean, the city, the government has in place plans to sort sort of elevate the infrastructure. We know that they're spending over $8 billion to improve the drainage system in the city. That comes after, the flooding that happened in April. We know that there's a brand new airport that's going to be built. Some of the smaller streets that are pretty popular are seeing some elevation. And, we've spoken to the government when writing this article, and they told us that there is a plan in place, the Dubai Master Plan in 2040, that, allows for better infrastructure to be able to bring in all these people by 2040, around 6 million people competing with the likes of Singapore. So there is definitely a plan, and, hopefully within the next 2-3 years, traffic coming into the office.
Does the government see these type of numbers to be sustainable? Again, going back to that original figure of 5.8 million potentially by 2040, does the government recognize that they have to be equipped to accommodate all of these people that are coming in?
So the government's line is, yes, those are the figures that we want to maintain. We want Dubai by 2040 to be standing out in terms of, global cities, to be an attractive city. But then there are two things that are at hand right now, Jumana, right? There is the elephant in the room. There's the conflict that is happening in the region. Yeah. Is it going to affect Dubai? We've spoken to economists, and they say, you know what, we don't see an impact right now, but if the conflict were to broaden, we don't know what the impact of that is on the city. And then there is also the fact that we already see rent prices not decreasing but plateauing. So we know that, people are still coming in. Are they coming in at the same magnitude they did last year or the year before, post-pandemic? Probably not. But the government is still expecting around 6 million people by 2040. They think this is an achievable plan, and they are working the infrastructure to sort of accommodate.
It's funny, when my husband and I drive around Dubai and we see all of these buildings getting put up week after week, it's building after building. The question we always ask is, who is going to live there? But of course, there's still a massive influx of people coming in. It's the newbies. Yeah. Abir, thank you so much for the report. You can read all about it on the terminal today. Bloomberg's Middle East economics reporter and Deputy UAE Chief Abir Abu Hamar. Well, for more of these stories looking into the intersection of wealth and power in the region, sign up for our Middle East Money newsletter on Bloomberg.com. And you can subscribe at Bloomberg.com/newsletters. It is on the screen right now. Now, for a look at some of the other stories we're following today. Bloomberg has been told that DP World has reversed the decision to pull out of a UK government investment summit beginning on Monday. And a source says the company is set to announce a $1.3 billion investment in its London Gateway port that will create 400 jobs. We're told DP World CEO Sultan Ahmed bin Sulayem will stick with the original plan to be part of the event after UK Prime Minister Keir Starmer walked back criticism of the company from some of his ministers. JP Morgan shares jumped the most in 18 months after reporting a surprise gain in net interest income for the third quarter. It also raised its forecast for the key revenue source, despite expectations that U.S. interest rates will continue to fall. The lender now sees full-year NII at about $92.5 billion, compared with the average analyst forecast of $91.1 billion. Meanwhile, Wells Fargo is downplaying the impact of rate cuts on its results. The bank on Friday posted third-quarter profit that topped analysts' expectations as a surge in investment banking fees helped counter a dip in lending revenue. The CFO, Michael Santomassimo, told us that they're expecting deposits to drive near-term performance.
Rates are still quite high on a relative basis from the last few years, and so you are still seeing repricing happen on the asset side. But in the near term, what really drive where we end up over the next couple of quarters is the deposit side, and we've seen some good trends there now over the last couple of quarters, where you've seen this cash sorting or the different mix changes really moderate. It was the slowest quarter so far since over the last couple of years, for that in the portfolio. And we've been able to adjust pricing just as we thought we would as the rates came down. So that'll be the factor that really drives near-term performance.
So, Mike, it's good to chat with you. To that point, then, does that mean that the move into higher yielding, say, CDs or money market funds, et cetera, that's definitely done as rates cuts come down?
Well, I wouldn't say it's necessarily done, but I think we saw the lowest pace of migration since rates started increasing, Alex. And so I think that's a good trend. And I think eventually what you see generally, or expect to see generally, is that what's left in checking accounts ends up being operating cash for a lot of people. So a lot of that shifting into other alternatives has happened already.
Yeah, my high yield savings account already coming down there. All right, let's get to the loan part of your portfolio. When do you think you see a really big uptick in loan growth? What's going to be that catalyst?
Yeah, it's really hard to say exactly, right? And I think when you look at what we're hearing from clients and what you're seeing, rates coming down, helpful, right? Because borrowing costs come down. I think there's still some uncertainty related to the election that's coming up. And then I think people want to see this base case kind of soft landing economic scenario play out a little bit longer. And then I think a combination of those things will start to build confidence. And then I think you may start to see people either build inventories or make additional capital expenditures that they've been holding off on now for a little bit. But I don't think it's just one thing. I think you really need to see a confluence of these things come together. And so it could take a little bit of time for that to really materialize in borrowing.
With regards to that client activity, Mike, and the election and the idea that once we get past that, maybe we see more activity, is that irrespective of who wins, or are they trying to hedge their bets?
Well, I think what people don't like is uncertainty, Romaine, and so I think once there's some certainty of the path, and you feel like that economic outlook is going to play out the way they think, I think those things are going to what really matter. And then assuming rates continue to come down and reduce borrowing costs, so I really do think it's going to be a combination of all those things. But it's the uncertainty part that I think causes people to hold off.
Wells Fargo CFO Mike Santomassimo speaking with Bloomberg's Alex Steele and Romaine Bostick. Well, coming up, Ghana is getting its first small modular nuclear reactor. More on this next. This is Bloomberg. Welcome back to Horizons Middle East and Africa. I'm Jumana Bersachi in Dubai. The U.S. beat out Russia last month to build Ghana's first small modular nuclear reactor. The agreement between Nuclear Power Ghana and Regnum Technology uses American NuScale power technology. Let's bring in Bloomberg's energy reporter, Paul Burkhardt, who joins us from Cape Town. Paul, good to have you with us. Just explain to us the significance about the nuclear deal between the U.S. and Ghana.
Sure. Good morning. So last month, this deal was announced between the U.S. and Ghana that uses small modular reactor technology by a company that's called NuScale. It's a U.S. company. And so I asked officials who were passing through South Africa why they thought they won. And they said, of course, it was the technology, but they were also said that they hope that it's a long-term relationship that's built between the U.S. and Ghana that even beats out the concessional financing that can be offered by a state-owned company, Rosatom, Russia's Rosatom, which can really offer quite significant concessional financing. And so in this case, the U.S. technology, they said in the long-term relationships, won out. They're also looking at Kenya in terms of doing a nuclear deal and also presenting kind of geothermal technology that's based on U.S. oil and gas drilling. So they're really trying to get into the energy space and throughout Africa.
Yeah, it's interesting. We were talking about the fact that more recently, when China held the Africa Summit, that President Xi has done several trips to the African continent. President Biden, no, and he had one scheduled. He obviously had to postpone it. Unclear if it's going to happen now. And I just wonder whether the U.S. is actually behind on diplomacy in the African continent, and in this example, specifically this type of diplomacy, in the sense that they're also helping build out with these nuclear ambitions and energy ambitions for many countries on the continent.
Yeah, that's the perfect comparison, really. President Biden was supposed to visit the Libido corridor, where there's copper critical minerals. And, the U.S. has become involved in other critical mineral projects where they're only become part of the supply chain. And so definitely you can say that they're behind there. And also in energy, I mean, Rosatom, if you take that as an example, that company has crisscrossed the African continent for a few years now, and they've signed deals. A lot of times, we're probably not going to see some of those come to fruition, if most of them. But it starts to get in, to the relationships between the bilateral relationships between those countries. So I think the U.S. is definitely catching up on that in energy and critical minerals.
Yeah, so interesting that it's Russia on the other side. Bloomberg's energy reporter Paul Burkhardt, thank you so much for bringing us the latest. Now for a look at some of the other stories we're following. Former South African Central Bank Chief Tito Mboweni has died at 65 years old. Mboweni served as the first black governor of South Africa's central bank and later as finance minister. He was hailed for keeping inflation and public spending in check. The former governor also served as a labor minister in the cabinet appointed by President Nelson Mandela after apartheid ended in 1994. Mozambique's ruling party has taken an early lead as votes were tallied from an election that was widely expected to extend its 49-year rule. Daniel Chapo, the candidate of the ruling Liberation Front of Mozambique, had 70% support in 30 districts out of a total of 154. Chapo needs more than 50% to win without going to a second round. A new independent challenger is running in second place after he rode a wave of youthful discontent in the gas-rich nation. And coming up, we will be taking a deep dive into the commodity space as Brent falls and iron ore jumps. We have all the details next. This is Bloomberg. Welcome back to Horizons Middle East and Africa. I'm Joanna Bersecci in Dubai. Commodities prices are steadying after China promised greater support for its stuttering economy. Metals have rallied in recent weeks on government support, but oil is under renewed pressure as China's stimulus underwhelms and as tensions in the Middle East rise. Let's bring in Bloomberg's energy reporter Stephen Sachinsky, who joins us from Singapore. It's been quite volatile for the oil complex the last few weeks because there's this pull and push of some of the geopolitical premium, but at the same time, the demand signals coming through from China today is a good example of perhaps the energy market being slightly underwhelmed by what the finance ministry of China unveiled on Saturday. So just talk us through the price action today.
Yeah, so, Brent is down a bit. We've been looking, the market had been closely watching for any Chinese stimulus. And while the government has said that they're going to support the economy, support the housing sector, which is a major part of the economy, the market was widely expected the finance ministry to provide some sort of dollar figure to show how much stimulus would be pumped. And since no U.S., no figure, no number, no dollar amount was expressed over the weekend, there isn't as much of an expectation that the government action will help to prop up demand in the world's largest crude importer. I mean, China is a deeply important market. And while you look at the supply-demand situation, essentially Chinese demand has been below what the market had hoped for earlier in this year. Oil is up. Brent is up about 9% so far this month. But that's mostly a geopolitical thing. That's a risk premium coming out of the Middle East as everyone waits for how the Israeli counterattack to Iran will shape up. There are reports over the weekend that they've kind of targeted some oil facilities in Iran, and if they do carry through with those strikes, that could potentially affect production. That, depending, we could see where they hit, depending from 500,000 barrels a day to 2 million barrels a day, and all of that will tighten the global supply.
Yeah, and just to also, let me just ask you about a report that caught my eye over the weekend. Iraq has said that it's pumped below its quota. I think this is for the first time in over a year or something like that. Just talk us through how this also might influence oil prices.
Yeah, I mean, Iraq had been pumping essentially above the quota. That's something that was hotly talked about in the last OPEC Plus meeting. They all have quotas that they have to meet. And so there's been pressure for countries to make sure that they're hitting that quota, or if they were above it, to compensate by going below. So there are reports that they essentially pumped at about 3.9495 million barrels per day, which is below their 4 million barrel per day quota. Because of the compensation for previously being above that quota, they were kind of targeting the 3.85 to 3.9 million barrels per day area, and all that together will sort of tighten the market further if some of that froth comes out. So you could see some, upward pressure on prices from there as well.
Yeah, absolutely. Stephen, thank you so much for bringing us the latest on what's been happening in these oil markets. Bloomberg's energy reporter, Stephen Chetinsky, thank you so much. All right, a quick look at equity futures. We are leaning towards the red as the market continues to digest some of the stimulus measures that came through from China over the weekend. But that was it for our show, Horizons Middle East and Africa. Stay with us for Daybreak Europe.